It's personal finance and investing. What are some of the things that should we look at when we are doing investments? Basically, will be taxation and how taxes will affect our investments returns. Number one is investing in securities or equities that are paying us dividends. This is when we buy shares in stock exchange or through NSE, through brokers, or better, when we buy a part of an existing business through private arrangements. That is equally purchase of equity. The most important thing that we must look at in that, there are two taxes that will be involved in shares, that is ordinary shares. Number one, there is capital gain. One reason why we buy shares is that we want to bank on their growth based on the performance and the growth of the business or the company from which you are buying. And a good example we'll give on those who bought the Safaricom shares during the IPO. They were buying at 5 shillings. Look at the current price. Not forgetting that ordinary shares will have their prices, the share prices fluctuating. But while we have those paper losses and paper gains, one of the important things is the growth that is attributable to increase in price. That's a growth. When you dispose a share, when you sell your shares, you are selling at a price that is higher than the price that you bought them. The difference is what we are calling a capital gain. That capital gain is now taxed at 15%, which is withheld by the company for the taxman. The other tax that is involved in equity shares is the dividend income. When a dividend is paid out, or when a dividend is declared, whether to be paid on a monthly basis, quarterly, annually, or semi-annually, a withholding tax at the rate of 5% will be subjected to that amount, then withheld by the payer, that is a company, for onward transmission to the taxman. So that ideally gives you the two incomes that you expect in equities. That is a capital gain and the dividend as an income. Another income that relates to acquiring equity. If you buy or if you purchase a business, an existing company, a part of it, it may give you an opportunity, or you might acquire control that will require you to sit in their board. In the board, you'll be earning sitting allowances and other form of allowances. But if you have a controlling stake, one thing that you work out, because every director has a contract with the company, you come in with a contract of consultancy. Whereas a consultant, what you'll be paid through the board will be consultation fees. And the consultation fees attract a withholding tax of only 5%. Sitting allowances will attract a tax of 30%. If you are to be a full-time working director, you'll be more or less treated as an employee, and you know the kind of taxes that relate to the payroll, high taxes. But what you do in such a case, you are a consultant, 5% withholding, a lot of saving. But if you were to get in the payroll, because you are owner of the business and you control a holding in that business, what do you craft? you pay yourself the minimum wage. Because remember, there is a tax relief that goes to the minimum wage earners in order to give us a zero pay as you earn. You pay yourself the minimum wage. Notably, you might have seen, those who are keen enough, many innovators, many entrepreneurs who have come up with serious enterprises. They even cleverly, by consultation, they hire real people, professionals, for advices on taxation. And one good advice is that as the owner with a control, pay yourself the least, even $1, 1,000 shillings, 10,000. Because that one to your end saves on the huge taxes that are effected through the payroll, which go as high as 35%. So once you have gone through the payroll, as a consultant, you are at 5%. Through the payroll minimum wage, no tax. You're not paying any tax. So that is more or less the taxes that relate to holding equities. Either you are buying through NSX stock exchange, IPOs, and you're buying amounts that do not give you a control or controlling stake. There's a 5% withheld on dividends and the likes. The second category of investment is if you are buying preferential shares or fixed income securities, where fixed income securities have a guaranteed rate of return, unlike equities. These fixed income securities pay a return in interest. So for interest, the withholding tax is at the rate of 15%. And this is regardless. All interest from fixed income securities, all interests are taxed at the rate of 15%, which is withheld and transmitted to the taxman. One important understanding, or what you need to know, is that the withholding tax is a final tax in most of the cases. Whether you are earning from a fixed deposit account interest, whether you are earning it as an interest rebate through SACCO deposits or a trade credit union deposits, if you are earning interest through treasury bills, if you are earning interest through fixed interest bonds, if you are earning interest from preferential shares or interest from securities, are taxed at the rate of 15%, which is withheld. On top of that, some of these instruments, like for preference shares, they may be disposed at a gain. That gain, again, will be taxed at 15% withholding. Another area that is very important for an investor and for your personal finance management is on how you tax benefits that accrue to you as the owner or as an employee from your company. Why so? When you register a company or when you run your business in a form that gives it the LLC status, that is the limited liability company status, that is a status. Whether a business can be run as a sole proprietor, it can be run as a partnership, it can be run as a company, but what distinguishes the three is the LLC status. Once a business acquires the LLC status, that means it gives the business an autonomy from the owners. We draw a line, or the business and the owners are treated as two separate entities, in such that the owner and the business are two individuals or two persons who can transact between each other. For that reason, or owing to that separate entity approach, then Any benefit that you as an owner who is also an employee in your company, whatever benefit that you accrue from that business, whether direct, in cash, or in kind, will be taxable. So it's very important for one to understand, for you to know the specific limits that are given for all these benefits. Because whether it is you as the owner, who is also an employee, and all other employees that you recruit in your company, their benefits, whether cash or in kind, are taxable. But there are limits that are given that are exempted from taxes. One specific benefit that one can use is a benefit attributable to housing and motor vehicle. This company that you form, put your assets into it. Remember, you have the control, you have the controlling stake, you are the majority shareholder. What do you do next? Once you put all your assets in the business, it is important we know that when it is not in your name, when you don't own it, it can never be taken away from you. It cannot be taken away from you. So you are controlling your assets in the business and accruing the benefits to yourself. So look at how you can use a motor vehicle, your vehicle, in the company to save on taxes or to minimize your tax liability. We will look at how you are going to use your house in the name of the company and reduce your tax liabilities. More on to that, your company, you can institute a trust in the name of a company that manages your assets, and you become a trustee for that trust, and you acquire such benefits, and you can use the same trust as a legacy investment. Those are salient, important ways that you work out to manage your tax liabilities as an investor. So, this is what you do.